You're listening to the Retire Coast podcast, where money, business, and lifestyle come together. Join us each week as we explore smarter financial planning, starting and growing businesses, and building the life you want at every stage, from Millennials and Gen X to today's retirees.
Welcome to the article written for you, a millennial, and also some Gen Zs, about 11 housing myths that are holding you, meaning millennials, back, and the truth you need to hear. This article goes into some detail about the top 11 things that are most commonly misunderstood, and that misunderstanding is passed around from person to person, often on social media. In fact, I had recently had a conversation with someone who was emphatic that the information that they had was absolutely true and correct when it was not. So what we're going to do here is let you know about these myths, what they are, and I'm sure that you've probably heard each one of them. And then we're going to do a bit of a deep dive, both on the audio side with this podcast and even further with our very long article, but you can skip through with the table of contents that's posted on retirecoast.com. Now, that article has a lot more in it, including sources for all of these things. So if you doubt what's being said in this podcast and also in the article, you can check out the sources for yourself. But it's much better to know what's real and what's not. Just because someone's passing it around, what credibility does that person have? Where did they hear the information? So let's get into it and try to dispel these myths, because they are, in fact, holding back a lot of millennials from making key life decisions. Once you know the truth, you'll find out that things aren't quite as bad, at least with respect to these 11 myths, as you may have thought. So please listen. We're going to present a dialogue between two individuals discussing this. I think you'll find it fascinating, and it's level. It's not taking a position on one side or another. It is simply explaining the information that's out there and why it's a myth. So please stay tuned. It'll be with you in just a moment. And don't forget to go to retirecoast.com to read our full article and all of our articles written for millennials in our Millennial Hub, and use our calculators designed specifically for you and for Gen Zs also. Starting out in life, you need a specific type of calculator for some of the decisions you're going to make, and we have many of them in here for you. So we've done all of these things to try to help you make some good life decisions and feel good about things. Thank you.
Welcome to the Deep Dive. If you're a millennial or, part of Gen Z, you're probably living in this constant state of, financial whiplash.
That's a good way to put it.
Yeah. The sources we've got in front of us today, which came from listeners just like you, they confirm this just constant barrage of information, or maybe more accurately, misinformation about housing.
Deeply soul-crushing misinformation.
Exactly. Every headline is screaming crisis. Every viral post you see tells you the game is rigged, the deck is stacked, and that owning a home is it's a fantasy. Something reserved for your parents' generation.
And that feeling, that sense of powerlessness, that's precisely what we have to address first. The sheer difficulty of today's market. High rents, inflation that just won't quit, huge student debt loads, all of that is real.
Of course.
We absolutely want to validate that struggle, but we also have to recognize that the constant noise breeds this really crippling pessimism.
Yeah.
When you believe the system is fundamentally broken, that it's impossible to navigate, you just stop trading.
Exactly. And our mission today is to cut right through that noise. We want to replace that social media panic with clarity, with confidence, and, above all, with hard, actionable facts. Mm-hmm. We're taking the source material you provided us, this systematic breakdown of the most stubborn housing myths out there, and we are doing a surgical deep dive into 11 of the most persistent, most paralyzing narratives.
And the stakes couldn't be higher. These myths are not harmless arguments you have online.
Not at all.
Believing, for instance, that you absolutely need a 20% down payment, or that giant corporations are systematically buying up every single starter home. that actively shapes your life decisions.
Huge decisions.
Monumental ones. Where you live, how you manage your debt, what career you pursue, your long-term financial security. Our goal today is to shift that frustration, that feeling of helplessness, into a clear, tactical plan.
So we've got 11 of these incredibly persistent myths to get through. We've organized this whole discussion into 3 big themes, just to give it some structure. First, we're going to hit the big, broad ideas, the corporate and systemic issues.
Right, the idea that Wall Street is locking you out, or that a CEO's paycheck is the reason your rent is so high.
Then we're moving on to the cold, hard market realities. We're going to look at what interest rates actually mean in a historical context, how today really stacks up against, say, the 1980s.
And separating out the contributing factors, like immigration, from the core structural problems that have been building for years.
And finally, we'll tackle the myths that center on personal finance and independence. You know, those damaging assumptions about student debt, the myth of that rigid 20% down payment, and whether renting is truly just throwing money down the drain.
Okay, let's get into it.
Let's unpack this and start with maybe the biggest, most emotionally charged viral culprit out there. Okay, so let's unpack this whole corporate conspiracy idea first, because I think it feeds directly into that feeling that the game is rigged. Myth #1. Big corporations like BlackRock are buying up all the homes.
Yes.
This narrative is just, it's everywhere. It's so concise, it's dramatic, and it gives you a perfect, easily identifiable villain to blame.
It is the perfect narrative, and it starts with a really fundamental confusion between 2 totally separate companies that just happen to have similar names.
Yep.
BlackRock, which is the world's largest asset manager, does not buy single-family homes.
At all.
Not directly. They primarily invest in financial products, so things like mortgage-backed securities, bond financing, and they fund large-scale multifamily developments, think massive apartment complexes.
Okay, so if they're not out there bidding on 3-bedroom ranch houses, where does this whole idea come from?
There are really 2 main sources. First, like I said, the name confusion. People mix them up with Blackstone, which is a totally separate private equity firm.
Blackstone.
Right. Now, Blackstone did basically pioneer the institutional single-family rental market after the 2008 crash. They were buying up distressed properties. But they've pretty much exited that space now.
And the second source.
The second is that BlackRock holds these small minority stakes. We're talking like 6 or 7% in publicly traded rental companies. Companies like American Homes for Rent or Invitation Homes. But holding a small stake in a company is a world of difference from being the primary owner buying the houses.
That distinction is crucial. But okay, setting BlackRock aside for a second. Those other institutional investors, they do exist. They are buying properties. So we have to look at the actual scale of it.
Yes.
The sheer size of the housing market is what puts this into context, right?
That is the essential number that gets completely left out of the viral posts. The United States has something like 85 to 86 million single-family homes.
86 million. Okay.
Of those, the inventory that's used specifically as single-family rentals is about 15 to 18 million. And the large institutional investors, the firms that own, say, over 1,000 homes, they only own about 450,000 to 600,000 of those properties nationwide.
So wait, 600,000 out of 86 million total homes.
Exactly. It's less than 2% of the total national inventory and only about 3 to 4% of the entire rental stock.
Oh.
Now, in any given month, their purchasing might spike up to 5% of sales. But the cumulative national impact it's just negligible. The whole narrative that Wall Street is vacuuming up the supply and locking you out is just not supported by the overall numbers.
But I want to introduce a challenge here, because this is where the nuance really matters.
Right.
What if that, 2% of national ownership is heavily concentrated?
Go on.
Like, say it's all in 3 specific booming Sunbelt cities, Atlanta, Phoenix, maybe parts of Florida. And what if those firms only focus on starter homes, that, $250,000 to $350,000 price range? Doesn't their presence there make the local market an absolute catastrophe for first-time buyers?
That is an excellent point. And yes, the institutional presence is hyper-concentrated. In those specific zip codes, they absolutely add a layer of competitive pressure.
Which is deeply frustrating.
Deeply frustrating for first-time buyers. That pressure shows up in 2 ways. It raises the price bar, and it makes cash offers the norm, which is just so hard for a regular buyer to compete with.
Right.
But, and this is the key, that local pressure is a symptom of the larger national supply shortage. If we simply had enough houses built nationally, that specific localized competition would ease up in a major way.
So if the big corporate players aren't the main issue on a national level, who is buying up the vast majority of investment properties?
It's overwhelmingly who the source material calls mom and pop investors.
So regular people.
Regular people, individuals often from older generations who own one, maybe two or three properties. They own about 85 to 90% of all the investor-held properties in the U.S. They're the ones providing the rental service that the big institutions get blamed for.
And their presence actually helps in a weird way by adding rental supply to the market.
Precisely. The demand for rentals, driven by job flexibility and the fact that we're not building new apartment complexes fast enough, it just far outstrips the supply. If these smaller investors weren't creating rental inventory, the rental crisis would be even worse.
Okay, let's talk about another key part of this myth. The idea that these big companies can just afford to overpay all the time because they have infinite cash.
Right. So we have to define a term here. Rental yield. This is basically the ratio of how much rent you get from a property in a year compared to how much you paid for it.
Okay.
Professional investors, whether they're big or small, are buying these properties to generate a profitable rental yield. They're doing these complex calculations on vacancy rates, maintenance, rent appreciation, all of it. They absolutely cannot consistently overpay and stay profitable. Their shareholders would revolt.
So their advantage isn't that they can bid $50,000 over asking price. Their advantage is the certainty of their offer.
Exactly. Their advantage is making an all-cash offer and, typically waiving the appraisal and financing contingencies. For a seller, especially an older homeowner or someone managing an estate, that speed and certainty is often more valuable than squeezing out every last dollar.
And the data shows something pretty fascinating about those cash offers, doesn't it?
It does. Data from 2024 and 2025 shows that all cash buyers, whether they're a big institution or just an individual, they actually pay, on average, about 10% less than buyers who use a mortgage.
Wow, less.
Yes. The seller is essentially giving them a discount for the convenience, the speed, and the guarantee that the deal won't fall through at the last minute. The big investors aren't overpaying. They're leveraging certainty to get a better deal. It's just a function of the market.
So the big takeaway here is that while the local impact can be painful, the energy that's misdirected at blaming Wall Street should really be redirected toward the actual structural flaw. We just haven't built enough houses.
That's the core issue. It's a supply issue, not a Wall Street takeover. Shifting your focus means maybe exploring some underrated markets or, far more effectively, advocating for better local zoning that allows for more construction.
And that blame often shifts really quickly from institutional investors to another very visible target of frustration. Which brings us to myth #3. CEO pay and corporate greed are driving up housing costs and stagnant wages. And we have to start by just acknowledging the huge and legitimate frustration about this disparity.
It is entirely legitimate. The numbers are staggering. At the big S&P 500 companies, the CEO to worker pay ratio hit 285 to 1 in 2024.
That's insane.
It is. If you go back to the 1960s or 70s, that ratio is more like 20 to 1 or 30 to 1. The optics are terrible. And when people see that gap while they're struggling with wages that aren't keeping up and the housing costs that are exploding, the natural impulse is to connect the two.
The impulse is to say, hey, if we just took those massive executive salaries and redistributed them, we could pay workers more and bring costs down. But you're here to deliver the aha moment that basically disconnects those two ideas.
I have to state this very clearly. Executive compensation packages. They're a function of shareholder expectations and corporate structure, but they do not inflate the cost of your house.
Not at all.
Housing costs are driven by these deep structural issues: land availability, permitting delays, zoning restrictions, and that massive, massive deficit in new construction.
So to really illustrate this lack of a direct economic impact, we have to run the numbers on the sort of extreme fantasy scenario from the source material.
Let's do it. Let's set up the hypothetical. Imagine every single CEO of an S&P 500 company, so about 500 people leading the biggest corporations in the country, they all take a 100% pay cut for 1 year.
So they work for free.
For free. Zero compensation. Then we take that entire massive pool of savings and we distribute it evenly across all 130 to 155 million private sector workers in the U.S.
Okay, what does that total equal redistribution amount to for each worker?
It would add only about $70 to $75 per worker annually.
$75 a year.
For the entire year. To break that down, you're looking at roughly $1 to 35 cents per week. That is the extreme reality check you need.
Wow.
Even if you completely eliminated CEO pay at the biggest companies, the wage bump is relevant. It's economically irrelevant It wouldn't meaningfully raise the minimum wage. It wouldn't lower inflation. And it certainly wouldn't make a $600,000 house in Seattle suddenly affordable.
That's incredible. The size of the total U.S. labor market is just so immense that even billions in compensation, which sounds like a huge number for one person, it just becomes a tiny ripple when you spread it out that broadly.
Exactly. And we can use the hamburger example to bring this down to the consumer level.
Right.
Take a huge national fast food chain. If their entire top executive team suddenly worked for free and all those savings were passed through to the menu prices, that $14 burger would drop by only a few cents.
Why so little?
Because the real dominant costs are the ingredients, the frontline labor, the energy to run the fryers, regulatory compliance, and the rent on the restaurant building, not the executive pay. Executive compensation, while it's often controversial, is economically just a drop in the bucket compared to the sheer operating costs of a modern company.
So while the outrage over the pay disparity might be morally justifiable, trying to connect that pay to the structural housing deficit or general inflation is just. You're misdiagnosing the illness.
Precisely. We need to focus energy where it can actually create change. Zoning reform, increasing construction efficiency, or, on a personal level, improving one's own income.
This leads perfectly into myth #4. Big corporations aren't paying enough in taxes. This is a political staple, right? Make big corporations pay their fair share. The promise is that you can fund all these social programs and housing aid without it affecting the average person.
This myth sounds perfect, but it suffers from a really fundamental misunderstanding of what we call economic pass-through.
Okay.
We have to define what a corporation is actually doing, fundamentally.
Oh, so walk us through the function of a corporation as just an economic entity.
Okay, so a corporation is a legal entity. Its entire purpose is to sell goods and services to generate a specific profit margin for its shareholders. The critical concept here is that a corporation in a competitive market is what we call a pass-through entity. It doesn't absorb costs. It reflects them in the price of its product. When a corporation sets the price for a car or a software license or even your streaming subscription, it calculates all its inputs: raw materials, rent, labor, transportation, and yes, taxes.
So if the government decides to raise the corporate income tax rate by, say, 10%.
The corporation doesn't just, eat that cost and continue on as usual. That tax increase immediately becomes a new input cost. So the company recalculates its pricing model to recover that increase and maintain its target profit margin. That increased tax is then passed through to you, the ultimate consumer.
What does the data say about where that cost ultimately lands? Who pays for it?
Economic studies consistently show that 50 to 70% and sometimes even more of corporate tax increases result in higher prices for goods and services for the consumer.
So you pay for it at the checkout counter.
If you buy products from that company, you are paying the corporate tax. It's some indirect tax.
And what happens to the remaining 30 to 50% of that tax increase?
That usually comes out of two places. First, lower wages or reduced hiring. The company looks to cut other operating costs to offset the tax. Second, smaller return for shareholders, which means lower dividends and less growth in the value of their stock.
And who are the shareholders?
Crucially, they are often pension funds, your 401k retirement account, and everyday mutual funds. So the tax hits people indirectly through inflation, through wage stagnation, and through their retirement savings.
So the argument that higher corporate taxes would solve inequality without hurting regular people is a profound myth, because the costs always, in one form or another, just flow right back to the consumer and the worker.
Absolutely. The corporate tax is often favored by politicians, precisely because it's less visible than a direct income or sales tax hike.
Right.
It creates the illusion of making greedy companies pay, when in reality, the public bears the vast majority of the burden through higher costs for everything they buy.
Okay, moving on to what might be the most damaging of all these mental hurdles, because it really just removes your individual agency. Myth, #11. The system is completely rigged. You have no real chance. This is like the culmination of all the previous myths.
This narrative is poisonous because it excuses inaction. It tells you that your individual effort is futile. So Why bother saving? Why bother trying to optimize your career? Why bother learning the rules of the game? It just breeds this paralyzing sense of victimhood.
But the reality is that the U.S. free market system, while it's undeniably complicated and flawed, especially in its housing policy, ultimately rewards those who learn to navigate it.
Exactly. The counter strategy is mastery, not martyrdom. The system requires you to learn its rules. For example, the system to buy a house requires a credit check, a down payment, and the calculation of your debt-to-income ratio, or DTI. It's a process. It has rules.
And the positive data point here is that millennials, in really large numbers, are showing that they are learning the rules.
Yes, absolutely. Studies show that millennials have been actively improving their credit scores. The average score for younger generations has risen dramatically over the last 5 to 10 years. That shows that they're focused on mastery paying their obligations on time, reducing long-term debt, and building a financial history that lenders can trust.
So the actionable takeaway here is to take back that agency, commit to understanding the mechanics of the financial system rather than just feeling like you have to fight the system itself.
If you avoid long-term, high-interest debt like revolving credit card balances, and you pay every single obligation on time, you master the credit system. That mastery means you can use the system to your advantage, qualify for a house, get a better interest rate, and get better financial terms on everything from car insurance to your utility services. The system rewards those who understand its requirements. It's time to replace the doom scrolling with practical planning and system mastery.
Okay, so if the financial system isn't rigged by tax policy or CEO pay, and the problems are really these structural supply issues, the next biggest emotional barrier for young buyers has to be the cost of borrowing. Let's pivot to market reality, starting with myth #2. Today's mortgage rates are sky high and historically unaffordable. This perception seems entirely driven by comparing today's rates to that, sub 3% era we just went through.
That sub 3% era, let's say from late 2019 through early 2022, that was an economic anomaly. It was a once-in-a-generation aberration.
Right.
It was driven by unprecedented quantitative easing and stimulus during a global health crisis.
Yeah.
That 2.65% rate we saw in January 2021 was the all-time historical floor. So when rates returned to 6 or 7%, of course they felt catastrophic, but only because the comparison point was so completely distorted.
So what does the real history, the 5-decade history of mortgage lending, tell us about what is actually normal?
We can rely on Freddie Mac's primary mortgage market survey data for this. They've been tracking 30-year fixed rates since 1971. When you look at the overall long-term historical average from 1971 all the way through late 2025, that average is approximately 7.7 to 7.8%.
Wow.
That is the actual baseline for a normal mortgage rate in the United States.
That immediately reframes everything. If the historical average is 7.7%, where are rates today?
As of late 2025, rates are hovering around 6.18%. So that is significantly below the historical average. For context, the peak rate was 18.63% back in October 1981.
18%. I can't even imagine.
Our current 6.2% range aligns perfectly with the rates we saw consistently throughout the 1990s and the 2000s periods that were characterized by strong housing market growth and accessible home ownership for the generations buying then.
This reframing is critical, but the fear of high rates is keeping so many potential buyers just trapped in this waiting game. They're convinced rates have to drop back down to 4% or lower.
And that waiting game is incredibly risky because it ignores the supply-demand dynamic. The major forecasts from the biggest players, we're talking Fannie Mae, the Mortgage Bankers Association, Wells Fargo, they show very little evidence of a significant rate plunge.
So what are they predicting?
They predict rates will remain firmly in the low to mid 6% range through 2026 and even into 2027. Maybe easing slightly to 5.9% by then, but the consensus shows no return to that sub 4% territory anytime soon.
And the problem with waiting is that while you're waiting for that modest rate drop, the price of the actual house just keeps climbing because of the supply shortage.
Precisely. Home prices are still appreciating in most desirable markets. So even if rates drop by 0.5% or a full percent over the next few years, that modest rate relief almost certainly fails to offset the cost of buying a house that is appreciated by 15 or 20% over that same waiting period.
So you end up with the same or maybe an even larger monthly payment anyway.
Exactly. But without having built any equity in the meantime.
So the actionable path is to lock in what is, by historical standard, a pretty reasonable rate right now, start building equity, and keep that option to refinance later if those dream low rates magically reappear.
Absolutely. The strategy should be marry the house, date the rate, get into the market, secure your asset, and if rates drop later, you refinance. Focusing only on waiting for a historically improbable rate is a strategy for long-term failure in this kind of supply-constrained environment.
Okay, to put this rate reality check in its proper context, let's do the deep dive comparison. Housing affordability in 2025 versus 1985. This is a true generational comparison, looking at the average millennial buying now versus, say, their parents buying a house 40 years ago.
And to make this fair, we have to use inflation-adjusted figures. We take the 1985 numbers and we adjust them by a multiplier of about 3.03x to reflect late 2025 purchasing power. That way we can compare apples to apples.
Okay, let's start with where the parents, the 1985 buyer, had the clear advantage.
The primary advantage was just the nominal price tag. In real inflation-adjusted terms, the median home price was substantially lower in 1985. It was about $251,000 adjusted, compared to roughly $450,000 today.
So that's a 65% increase in real terms.
A huge increase.
And this leads us to define another key metric, the price-to-income ratio. Can you explain that ratio simply for our listeners?
The price-to-income ratio, or PI, is just a measure of how many years of the median household income it takes to afford the median house.
Mm-hmm.
In 1985, that ratio was about 3.5 times income.
And today?
Today, because home prices they've significantly outpaced income growth in a lot of desirable areas, the ratio is about 5.0 times income. So the entry point definitely feels much, much harder now.
That feels like a clear win for the 1985 buyer, but this is where the financial engineering and the real game changers come into play. The costs of entry and the ongoing monthly costs are dramatically different.
They are the biggest factors. Look at the key differences in lending. First, the average 30-year fixed mortgage rate in 1985 was a daunting 12.4%.
12.4.
Yes. Today, we're at 6.2%. Just think about the psychological weight of committing to 12.4% debt for 30 years. That is a massive financial commitment and risk.
And the second game changer is the down payment requirement.
Yes. Back in 1985, buyers typically needed a hefty 25 to 28% down payment. That was the standard.
Wow.
Today, thanks to a lot of government-backed programs we'll discuss later, the overall average down payment is 19%. But for first-time buyers, it's actually closer to 10%. That dramatically lowers the barrier to entry.
So let's look at the ultimate conclusion here. What does that combination, that much higher 1985 rate versus today's lower rate, what does that mean for the buyer's actual monthly budget?
This is the ultimate conclusion. Even though the home price was cheaper in 1985, the estimated monthly principal and interest payment consumed a much larger percentage of the median income because of that super high rate. In 1985, the P&I payment consumed around 40% of the median monthly income.
40%.
Today, the estimated monthly payment is actually lower in real terms, and it consumes only about 29% of the median monthly income for a qualified buyer.
So the reality is a trade-off. The entry hurdle saving up that down payment is way higher today because the price tag is bigger, but the ongoing month-to-month affordability for qualified buyers is significantly better in 2025 thanks to those dramatically lower interest rates.
It requires more saving and more determination to get in, but once you are in, the cost of carrying that debt is historically more manageable than what previous generations faced during those high-rate periods. That is crucial context.
Moving on to myth #6. Immigration is the main cause of housing shortages. This is a factor that often gets presented as the single cause of high demand, especially for rentals.
Immigration is a significant contributing factor, and we have to analyze it impartially. When you have massive, rapid inflows of people, especially when they concentrate in specific cities like New York, Miami, Chicago, those new arrivals need housing right away. And it's also pretty common for several people to share a single dwelling, which allows them to efficiently pool their money and bid up rental prices for the existing inventory. That certainly makes existing shortfalls worse.
Can we put some data context around the scale of recent migration, especially around the 2020 to 2025 period?
Sure. Mainstream estimates place the undocumented foreign-born population at around 13 to 14 million as of mid-2025. The massive inflow that happened during and right after the pandemic years definitely added tremendous sudden demand pressure to a housing market that was already suffering from a decade of low supply. The imbalance got much worse very quickly.
Have recent trends shown any relief on that demand pressure?
Yes, actually. By late 2025, policy changes, deportations, and people just choosing to move back to their home countries led to an estimated decline of about 1 million in the foreign-born population. That's the first decline recorded since the 1960s.
And what was the effect?
This decline began to ease demand and led to some rent stabilization, in some cases even modest reductions in those immigrant-heavy pockets, particularly for small apartments and shared housing.
So if it's a contributing factor but not the core crisis, where do we draw the line?
Immigration adds competition, especially at the rental level, and it hits those specific high-demand metro areas hard. But the core crisis is structural. It's chronic underbuilding, poor government planning, restrictive zoning that prevents density, and high construction costs. Even if net migration were zero, we would still have an immense housing crisis because we failed to build enough homes for 15 years.
Now we get to two myths that seem designed to just discourage any action at all. Myth #7, millennials are priced out forever, and myth #8, there's no affordable housing left anywhere.
Okay, let's tackle myth #7 first.
Yeah.
This narrative is just. It's utterly baseless, and it's highly destructive to your motivation. Millennials are, right now, the single largest group of homebuyers in the United States. They are buying houses faster than any other demographic group today.
But there is that timing delay compared to previous generations, which I think fuels the narrative of being left behind.
That's the key distinction. They reached homeownership later, about 33% ownership at age 30, compared to 42 to 48% for earlier generations at the same age. But as the older cohorts of millennials enter their mid-career years, their 30s and 40s, they are closing that gap rapidly.
How?
Through career growth, strategic debt pay down to improve their DPI, and using all those low down payment options we'll detail in a bit. They are not priced out forever. They're just starting later because of higher debt and a more challenging entry market.
And myth #8, this idea that affordability has just vanished entirely, it confuses geographic desirability with economic reality.
This is the confusion between expensive where I want to live and expensive everywhere. Affordability still exists in hundreds of U.S. markets, but it's very unevenly distributed. If your career or your personal life demands that you live in New York City or the San Francisco Bay Area, yes, you're going to face extraordinary financial constraint. But if you are geographically flexible, the game changes entirely.
Can you give us a specific data contrast that illustrates that massive gulf in affordability?
Absolutely. Compare the typical home price in a high-cost coastal market, like the San Jose metro area, where the average price can exceed $1.2 million, versus a growing affordable market like the Mississippi Gulf Coast, where the average home sells for about $225,000.
That's $1 million difference.
That difference changes your required annual income from maybe $250,000 to perhaps $65,000.
And the history of U.S. migration suggests that people move out for affordability, and eventually the jobs follow the people.
Absolutely. Think about the historical shift in Southern California. When L.A. became too expensive, people and jobs shifted east to Orange County. When Orange County got dense, the next wave went further inland to Riverside and San Bernardino.
And that's happening nationally now.
That same process is repeating nationally today, and it's being accelerated by remote work. Millennials are moving to affordable metros in the South and the Midwest that have robust, growing job markets. So the listener has two clear choices. Either significantly increase your income where you are, or relocate to an area where your existing income buys you dramatically more house and a real pathway to home ownership.
So we've covered the systemic villains and the market realities. Now we can move to the personal finance myths, starting with what I believe is the most damaging myth for first-time buyers because it just keeps them waiting for no reason. Myth, #5. You need 20% down to buy a house. Otherwise, it's impossible.
This myth is a legacy belief. It's a holdover from an era when private mortgage insurance, or PMI, was considered toxic and lenders were just far less regulated. In reality, today, there are numerous low-down payment solutions that make homeownership accessible for qualified buyers with only a small amount of cash saved up.
And waiting years for that full 20%.
It means you're likely letting the price of the house increase faster than your savings can accumulate. You're chasing a moving target.
So let's detail the options that allow people to get into the market with way less than 20% down.
The menu is extensive. First, you've got the government-backed options. FHA loans, which are insured by HUD. These require just 3.5% down and are available to buyers with credit scores as low as 580. Then there are VA loans for eligible veterans and active duty military. These are the gold standard. They require 0% down and, crucially, have no private mortgage insurance. And USDA loans for rural and suburban areas. Also 0% down for income-eligible buyers in designated areas.
And even if you don't qualify for those specific programs and you want a conventional loan?
Even conventional loans, backed by Fannie Mae and Freddie Mac, have fantastic low-down payment options. Programs like Home Ready or Home Possible, which allow as little as 3% down for first-time or lower-income buyers. And we can't forget the hundreds of state and local down payment assistance programs that exist.
Right.
They often provide grants or second mortgages that can cover the entire down payment and closing costs for qualified buyers.
So, if saving that 20% isn't the real barrier, what is the actual gatekeeper that lenders use to approve or deny a mortgage?
The real gatekeeper, the critical factor that lenders care about far more than the size of your down payment, is your debt-to-income ratio, or DTI. This is the most actionable piece of information you can use today. DTI is a simple ratio that measures your total monthly debt payments against your gross monthly income.
We need to dedicate some time to explaining DTI, because if the listener can master this, they can master the home buying system. How is it calculated, and what are the specific targets?
So lenders look at two ratios, the front end and the back end DTI. Front end DTI, or the housing ratio, looks at just the mortgage payment. That's your principal, interest, taxes, and insurance, or PITI versus your gross income. Lenders typically want this under 28%. But the back-end DTI is the big one. It looks at the proposed monthly mortgage payment plus all your other recurring minimum debt payments, credit cards, student loans, car loans, personal loans, against your gross monthly income.
And what's the magic number that most lenders enforce for that back-end DTI?
For a conventional non-FHA loan, lenders are generally looking for a back-end DTI of 43% or lower. FHA loans might allow for slightly higher ratios, maybe up to 50%, but 43% is the key target for getting the best rates and the easiest approval.
Let's simplify that for the listener.
It means that for every $100 you earn each month before taxes, you should not be committing more than $43 to minimum debt payments, and that includes your future mortgage payment. If your DTI is too high, even if you have enough cash for a 10% down payment, the lender will deny your application. They see the monthly payment as too risky compared to what you already owe.
So the actionable takeaway is that paying down high-interest debt is actually more beneficial than just saving cash. What are the specific strategies for improving DTI?
Focusing on high-interest short-term debts first is paramount. Pay off your credit card balances. Even a small card balance carries a high minimum payment, which spikes your DTI. If you have a car loan that's nearly paid off, aggressively tackle that. The key is to reduce the required minimum monthly payment, not just the principal balance.
That's a key distinction.
Reducing a minimum monthly debt obligation by $100 can have the same approval impact as saving thousands more in cash. You have to view high-interest debt as the primary obstacle to homeownership, not the down payment.
Okay, next, let's tackle myth #9. Student debt means you'll never recover financially. This is a core frustration for an entire generation who followed the advice to go to college but then ended up with massive debt and, questionable ROI on their degrees.
The frustration is completely valid. It is genuine drag on early career life. It delays major milestones like marriage and buying a home. However, debt is temporary and recovery is absolutely possible. We need to focus on the long-term payoff.
What's the ultimate financial positive that outweighs that initial debt burden?
The college wage premium remains strong and it grows significantly over a career. Studies confirm that bachelor's degree holders earn a median lifetime premium of $1.2 million to $2.8 million more than high school graduates. So while the early years are tough with debt repayment, the net present value of that degree over a 40-year career is massively positive. Your income doesn't stay static. It rises dramatically with experience, strategic career moves, and networking.
But the immediate problem is still that DTI. How do you manage large student loan payments today to qualify for a mortgage?
This requires a strategic pivot. You have to utilize income-driven repayment IDR plans. These IDR plans, especially the newer ones, calculate your minimum monthly payment based on your current income and family size, not on the total loan balance.
And that's huge for DTI.
It's a critical move. If you're pursuing homeownership, switching to an IDR plan can drastically lower your required monthly student loan payment. That immediately reduces your debt-to-income ratio, making it much easier to qualify for a mortgage. This is a key move to master the system.
We're also seeing a massive trend now driven by high debt and high demand, which is a pivot to skilled trades.
This is an accelerated recovery path, and it bypasses the high cost of a 4-year degree entirely. Many people are entering skilled trades because the demand is high, the training is often short and cheap, and the jobs are largely AI-resistant and recession-proof. We are talking about phenomenal, stable salaries that allow for aggressive debt payoff.
Can you give us some specific, compelling salary examples to show the potential?
Absolutely. Entry-level electricians and HVAC technicians can easily clear $50,000 to $65,000 a year. Specialized roles, like experienced shipbuilding welders in high-demand industrial areas, can earn between $70,000 and $100,000 annually, with specialized underwater welding going even higher.
And master plumbers.
Master plumbers often run their own small businesses and earn $80,000 to $120,000 plus. These are high-paying, stable careers that let individuals aggressively pay off student debt or save their down payment cash within a few short years, leading quickly to homeownership eligibility.
Finally, let's address myth #10. Renting is always throwing money away. This myth contains a kernel of truth that makes it so sticky, which is that buying does build equity.
That kernel is undeniable. Buying does build wealth because you gain equity as you pay down the mortgage, and the home's value generally appreciates due to inflation and market dynamics. Homeowners typically have significantly higher net worths in retirement.
But owning is not the default correct choice for every single person in every circumstance. The nuance here is essential.
It is. Renting is not inherently foolish, it's a trade-off. The decision has to be based on running the numbers for your individual circumstances, starting with your time horizon. If you plan to live somewhere for less than 5 years, the massive transaction costs of buying and selling, the realtor fees, closing costs, title insurance will almost certainly negate any equity gains you make. You'll lose money.
And what about all the hidden costs of ownership that renters never even see?
Owning a home demands a significant investment of time, inclination, and, financial margin for maintenance, repairs, and capital expenditures, like a new roof or an HVAC system. This often surprises first-time buyers. For many people who prioritize flexibility, travel, or career mobility, or who simply lack the time or inclination for maintenance, renting provides a massive, necessary benefit. It provides housing security without that unexpected financial or physical burden.
And location plays a huge role in this calculation, too.
Absolutely. Many young professionals want to live in dense inner-city apartments close to amenities, transit, and culture. Buying property in those specific hyper-dense areas is often prohibitively expensive or just unavailable. Renting allows them to live the lifestyle they choose, often sharing costs with roommates, in a location where buying is simply not financially viable. The decision has to be based on your time horizon, your willingness to do maintenance, and your lifestyle needs, not just some blanket generalization that rent money is wasted. So we've systematically dismantled 11 of these pervasive myths. All of them either misdirect your valuable energy or they actively paralyze you from taking action. So if corporate conspiracies, historically high rates, and that 20% down payment aren't the primary problems, then we have to confront the uncomfortable reality. The core problem is a complex, multi-layered structural crisis.
The source material really stresses that you can't reduce this to a single villain or a 30-second viral post. But we can isolate the 4 major drivers that are causing the crisis. Before we list those, though, let's revisit that critical concept of generational migration.
We are seeing history repeat itself. Millennials are not fundamentally different from baby boomers or Gen X. They flock to dense, job-rich cities in their 20s. But as they hit their 30s and 40s, as they form families and seek stability, they are suburbanizing and migrating.
They need more space, good schools.
They need more space, access to better schools, and financial breathing room. And the suburbs offer that.
So this means they're flowing out of the highest cost coastal behemoths, New York, LA, San Francisco, and they're moving into affordable metros in the South and the Midwest.
Right. The data shows millennials are leading the charge into cities like Raleigh, North Carolina, Jacksonville, Florida, and Austin, Texas, which is rapidly becoming less affordable, but still more affordable than California.
Yeah.
They're following a financial logic. They're realizing they can buy a beautiful $300,000 house instead of renting a $3,000 a month apartment. And remote work only accelerates the ability to make that move without necessarily sacrificing your career prospects.
Okay, now let's list the 4 primary structural drivers that the expert consensus identifies as the true core of this affordability crisis. These are the problems that actually require policy solutions.
These are the fundamental issues. They existed long before BlackRock was a household name and before those pandemic rates hit the floor. 1. Chronic housing underbuilding. This is the most profound problem. The U.S. has a massive cumulative deficit of an estimated 4 to 7 million new homes that should have been built since the 2008 recession. Construction just lagged dramatically for over a decade. Supply has not kept pace with population growth or demand. 2. Zoning and land use restrictions. This is the regulatory bottleneck. Single-family zoning dominates in so many suburbs and cities, making it illegal to build denser, more affordable options like duplexes, townhomes, or small apartment buildings near transit and jobs. This artificially constrains supply and pushes people further and further out. 3. High construction costs. This is the immediate financial barrier. labor shortages in skilled trades, rising material prices for lumber and concrete, plus increased regulatory compliance fees. It's driven the cost of building a new home up by 50 to 100% in many markets since 2010. Even if a builder can get a permit, the cost to construct is astronomical. 4, and finally, a demographic demand surge. The sheer size of the millennial generation, followed closely by older Gen Z, all entering their prime household formation years, late 20s to early 40s, created a demand wave that the already limited supply simply could not absorb.
That provides a really clear hierarchy of causes. But the author of this source material presented a nuanced, almost contrarian perspective on that second driver, zoning, which is often called the biggest policy lever we have available.
It is often touted that we must abolish single-family zoning entirely. The author argues that this is an overly simplistic and, frankly, a fundamentally unfair solution for many existing homeowners.
How so?
People who invested hundreds of thousands of dollars in a planned single-family community did so specifically for the quality of life, the yard size, the school district, the low congestion. They rely on that zoning to protect their lifestyle and their massive financial investment.
So if abolishing zoning in established single-family neighborhoods isn't the fair or practical answer, what's the proposed alternative solution to the structural problem?
The author suggests that the primary focus should be on decentralization, rather than just increasing density in already overcrowded coastal hubs. We should stop trying to jam millions more people into these fixed, expensive spaces like Silicon Valley or Manhattan.
To spread the jobs out.
Instead, the focus should be on incentivizing the creation of large job centers, factories, and tech hubs in smaller cities and rural areas where land is cheaper, permitting is faster, labor is available, and people can afford to buy homes right away.
We need to create smaller, distributed economic power centers all across the country.
Exactly. Instead of one massive Silicon Valley, we need 10 smaller Silicon Valleys distributed in the Midwest and the South. This alleviates the pressure on the legacy high-cost areas, it directs growth to where land is cheap, and it allows the current generation to achieve homeownership without having to earn $500,000 a year. It's a population distribution issue, not just a density issue. #outro.
So, you have now completed this systematic breakdown of the 11 most persistent myths that have probably been weighing on your mind, maybe even paralyzing your ability to act. We've moved from frustration and viral panic to clarity and specific, actionable financial understanding.
The facts are ultimately empowering. We know that historical mortgage rates are normal, not sky high. We know there are dozens of low down payment options available that make that 20% myth totally obsolete.
Right.
And we know that while the market is undeniably challenging, affordable markets are out there and they are growing rapidly.
And maybe most importantly, we've definitively debunked the idea that individual agency is dead. The system is not rigged against you. It simply rewards those who learn its mechanics, mastering credit, ruthlessly tackling DTI, using strategic repayment plans like IDR, and making informed career pivots.
Success is built through informed decisions, through flexibility, and through sheer determination.
So we hope this deep dive helps you break free from those paralyzing narratives and recognize the power that you hold. Now that you know the facts, that rates are manageable, down payments are achievable, and affordable markets exist, the only remaining obstacle is the decision to act on this knowledge.
So we leave you with this final provocative thought. What one concrete step, checking your debt-to-income ratio and aiming for 43% or lower, mapping out a 6-month savings goal toward a 3.5% down payment, or spending 3 hours today researching an affordable relocation market using the tools we've discussed? What one step will you take today to break free from the doom scrolling and start actively building your financial future?
Translate this knowledge into practical math. Don't just absorb the facts. Use the tools, the mortgage qualifiers, the rent versus buy calculators, the IDR plan calculators, and the relocation guides to map out your personal path to financial independence and home ownership.
Take control today. The path is challenging, but it is now clear.